In terms of this Fed meeting and your expectations out of tomorrow, what do you think the biggest thing investors, economists, really the world should be watching for?
Well, I think we're looking at a couple things here. One is, how does the Fed seeing the economy? What are they seeing the risks to the economy? And then how do they express that in their language? So I expect that they're continuing to see the economy as strong. The most recent data we have, the hard data we have on employment, on industrial production towards the end of the year was quite solid, quite good. But there's also a number of downside risks out there that the markets are focused on. There's the global economy appears to be slowing and slowing somewhat unexpectedly and somewhat stronger. China and Europe are good examples of that. Markets have tightened some since the fall, although the stock market's come back some. It's still below where it was and risk spreads are higher. There's data uncertainty associated with the shutdown of the economy of the government. Some of the surveys of business and consumer sentiment have fallen off, as we saw today. So there seems to, although things look good in the real data coming in, there are a bunch of downside risks. Inflation is controlled. The Fed will be patient.
So, Don, let's talk about exactly what this means for policy moving forward. If we talk about rates first, we can talk about the balance sheet afterwards. You're going to be focused on the language which last time round said, quote, some further gradual increases. Do you think they'll actually change that language?
Yes, I do, Wilfred. I think that was a signal that was consistent with the dot plot, which showed several more increases. I think what we've seen since then is an attempt to back off and to downplay strong forward guidance. So I think they'll try to draw back on the forward guidance. This has been a consistent theme that the Powell Fed has done, and they've done it as the interest rates have gotten higher, closer to neutral. The economy has been fine. They feel like they don't need that forward guidance, and I think this is another opportunity to dial that back, and I would expect them to do that. They could dial it all the way back. They could just say future interest rate changes will depend on our assessment of how the economy is doing relative to our dual mandate of maximum employment and stable prices. I kind of don't expect that. I think what we saw in the dot plot and in their language is there's a better chance that the next change in rates will be higher rather than lower. So I think they could revert to some of that language we've had earlier about the extent and timing of any increase in rates will depend on the data coming in.
Don, I'm glad you brought up the dual mandate and specifically the price stability part of that. Inflation, there were a lot of fears last year that inflation was going to really flare up. We haven't actually seen it. How is that going to, I guess, color and affect the policy this year, especially given the fact that we do have low unemployment?
So I think it does color and affect it. So that's a great point, Morgan. I think one of the things that allows them, the major thing that allows them to be patient and to assess the data as it comes in is the fact that one half of their dual mandate, one piece, that inflation seems to be quite contained. And in fact, it was surprisingly low for a while in the third, early fourth quarter. Most recent data are back a little stronger, but it's still well within the range of where they want it. So as long as that continues, they can be patient about deciding when and if they need to raise rates further. So that's a key point.
What about the balance sheet here? Do you expect the Fed chair to stick to the script? I feel like if we're really focusing on the nuances here, that when he's had script in front of him, he said exactly what the market wants to hear. But at other times, maybe his true feeling is that it should still be semi on autopilot.
Well, I think he'll definitely stick to the script that he comes out of the FOMC with. He is representing the committee, and I'm sure his verbiage, his language will reflect that. I think it's probably on semi-autopilot at this point. You've got $1.6 trillion of reserves in the system. That's more than they need to run policy, even with an abundant reserve operating scheme. and a floor system, they don't need all that, but they're surprised, and other observers are surprised that the demand for reserves have been strong as it has been, putting a bit of upward pressure on the funds rate relative to the interest rate on reserves. So I think they don't know how much further it needs to go. So I think I would expect him to say, we're going to continue to let that balance sheet run off, and we're kind of feeling our way. We're learning while it goes on. No one's ever done this before. We're breaking new ground. We're learning. But for now, the balance sheet will continue to run off.
Don, is the data from international economies and the rhetoric from their respective central banks another reason for the Fed to hold back a little bit?
I think the global situation is definitely another reason, and that's reflected in the other central banks. I think in many places, we've already mentioned China and the euro area, they're seeing weaker data than they expected. The central banks are being flexible and are poised to take steps if necessary to keep their economies going. So the Central Bank of China has cut reserve requirements. The ECB has said it would consider further actions if things weaken further. So I think everywhere in the world we're seeing a bit slower economy than people expected, no real flare-up of inflation, and that keeps the central banks very much in the mode of data dependence, as the Fed has said, and trying to see where this is going to go, where this slowdown is going to go. The other central banks, China and the ECB, are actually seeing more slowdowns, real slowdowns in their incoming economic data than the U.S. is. The U.S. we have this peculiar situation in which the incoming data still, with a few exceptions, housing, et cetera, still look pretty strong. The markets are signaling concern, worried about feedbacks from overseas. So the other central banks really wrestling with perhaps even more difficult problems than the Fed is right now.